need rates to keep rising, but we need to do it in a slower, more orderly fashion.
The Fed really haven't pushed back in any real shape or form against those higher rates.
When things are really ripping from a growth or an inflation perspective, you can't say things don't look good.
The reopening is not even in the market yet. This value trade is still relatively new.
There's plenty of scope for more fiscal stimulus, and it looks like we are going to get it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Seemingly everybody getting bulled up from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. With equity futures down 11 on the S&P, we're negative 1/3 of 1%. Tom, increasingly, I just feel like we're going to have this conversation around U.S. exceptionalism for a while now.
Well, it's very lonely. It's the success of the United States and all of it about the medicine, as we heard from Dr. Adalji of Johns Hopkins a moment ago. My major message, John, right now is in the last hour, the improvement in the tape. When we opened at 6 o'clock, it was grim, and it's just simply gotten better here as we try to digest that huge 600 Dow point move yesterday.
As the session grows older, I'll push aside your Dow point move from yesterday.
603 Dow point move, I believe.
Big session, though, on the S&P 500.
And Russell 2000 moving as well. They all moved. On.
Euro dollar with a break of 120. Briefly, Tom, a 119 handle just for a moment. And the compare and contrast between the United States and the rest of the world right now is fascinating. Europe's struggling to roll out this vaccine. Really bad news there. And not just about the supply. It's now about the acceptance of the AstraZeneca vaccine in the population. Away from that in China, pushback from the regulator about bubbles. And then you've got the United States just pedal to the metal.
And again, I'm going to go range-bound. I mean, to me, it was hugely, John, range-bound overnight. Ed Morse publishing new ranges on oil, maybe $40, $50, maybe $60 a barrel. But is a range a bad idea? I don't think ranges are a bad idea right now.
Elisa, things are getting better.
Yeah, and there's been a theme where generally when you have a global resurgence, you have a weaker dollar. This time, will it be different? Can we have this ongoing strength in risk assets with a strengthening dollar based on that exceptionalism that you're talking about? And Ibrahim Rahbari was saying, not necessarily, the dollar can still weaken, but people are going into the U.S. because of that strength that they're seeing that you're talking about.
Yeah, came into this year and everyone was talking about global synchronized growth, Tom, and the high beta plays to that. EM, European cyclicals, mid caps, small caps in international. And Tom, I sit here now and I just don't see it.
Well,
really struggle to see it.
The institutional play, that's a really good point, John. The institutional play may be there clearly on small cap and clearly on international. Maybe we'll see that, maybe we won't. But the distinction here is the medicine. The greatest disparity on March 2nd are the medical stories out of the United States versus the medical stories, you name the cities, John, Paris, Jakarta, Berlin, on and on.
Couldn't agree more. Here's your price action this Tuesday morning. Good morning to you all. The equity market looks a little something like this on the S&P 500. Pulling back 10 points and down 1/4%. In the bond market, yields are higher. The curve is steeper. Your yield on a 10-year maturity, 1.4445%. Yields are higher, Lisa, by about 3 basis points.
Yeah, the yields are higher and people are looking to that growth, to some sort of action in Washington, D.C. Also today, we are going to be hearing from Gary Gensler. He's going to be presenting in front of the Senate Banking Committee to potentially become the SEC chair. Very interested to hear what he has to say about the GameStops of the world, the Robinhood trading, and the froth that you're talking about and that we've seen people talk about with the ARK Investments and Cathie Wood. Then also today, the Fed Speak continues this drum roll of speaking before the Thursday Fed Chair Jay Powell's presentation. Today, we've got Lael Brainard and Mary Daly both speaking. I'm very interested in what they have to say about some of the turmoil in the bond market. Lael Brainard actually had some interesting things yesterday to talk about possibly some sort of ongoing repo operation to calm some of the liquidity concerns in the Treasury market. And then at 1 p.m., Joe Biden will participate in a virtual lunch with Senate Democrats. This comes, of course, as the Democrats try to get that $1.9 trillion stimulus bill passed by March 15th, John.
Lisa, thank you. Let's turn to our guest this morning, Peter TCHIR, Economy Securities Head of Macro Strategy. Peter, I remember about 10 months ago getting a message from you about how constructive you were about the outlook. And at the time, there was almost some negative connotations attached to being optimistic because everything around us was so negative. It was uncomfortable to be long, you were long. Looking forward from here, you're still long and constructive. Why, Pete?
I am, but it's more reduced down to what's going to benefit from infrastructure spending, what's going to benefit from resumption of travel, And at the other end of the spectrum, there is froth in parts of the market. So I am pulling back from those, really kind of actually nervous that we could see a significant pullback in some of the frothy end. So it's a little bit more of a mixed bag when looking at my portfolio. And I've also been really pulling out of Europe and the rest of the world. I think they're just not getting it.
Peter, define catharsis here. The 2-year yield last Thursday in this crisis was a 5.1 standard deviation move. I mean, clearly that's catharsis. But is that so isolated it doesn't matter? Do you see that emotion that means a trend change?
I think people got it wrong. It definitely was concerning to me where we saw in yields. But I do believe that this Fed is extremely committed to not hiking, that they are going to try and drive the unemployment down to sub 3%, that they want everyone back to work. And so using the calculus of what the Fed used to behave like is going to lead to wrong decisions at the front end of the yield curve. So look for them to really stay committed to no hikes, and that's going to keep that front end anchored, keeps the back end a little bit stable. So I think that's going to be good for growth, but we've got to be cautious on that.
So let's go to where you do think that there's going to be some catharsis. You said that there could be a significant pullback in frothy areas. Talk to us about what that looks like.
Well, I think, for lack of a better word, somewhat it's those archetype stocks that you mentioned earlier. There's been an accumulation of, stocks. It's becoming very concentrated who owns them. There's a positive story, but the inflows have been supporting it. And you've seen a couple times last week where you get these little cracks. And when you get outflows with the selling pressure, the move is very, very dramatic. So it's a very small subset of the market, but it's been an important part of some of the indices.
You said something really important, Pete. They're just not getting it. You look into the rest of the world, they're just not getting it. Do you think other investors are, quote, getting it? When you look at what's happening in Europe right now, when you look at what's happening in China at the moment, and then you look at the commodity market at things like copper, it's hard to reconcile a lot of things going on in this market with what's going on the ground in these respective countries.
Yeah, I'm increasingly worried about Europe not getting it, and also emerging markets, right? Emerging markets have benefited greatly from this run on commodity, but they seem to be really struggling with how to deal with COVID, how to get past it. So I do see the separation between the U.S. and I see ongoing friction between the U.S. and China. And I think that's really going to impact both Europe and emerging markets. So I'm nervous on where those are in terms of valuations.
Does that shape what you are long in the United States?
Definitely. Within the U.S., I completely think we are going to get infrastructure spending. It's going to be unique infrastructure spending. I think we're going to actually get 5G built out in the inner cities. I think we're going to do some interesting things that let that infrastructure spending really be dramatic. I think we actually see an infrastructure bank that will allow the spending to be more focused than if just Congress does the appropriations. So I'm excited for that. And anything that's kind of, bridge and tunnel building should be good as well.
Peter, you channel the Beverly Hillbillies in your research note. I know Jed Clampett got lucky with a gun and up came a bubbling crude. Explain to us the Bubblish now and the Beverly Hillbillies.
So what I want to talk about there was a fund that really resonated with me back in 2007, 2008. It was a commodity fund. It bought a lot of high yield equities. So, and those equities had relatively small floats. As money kept coming in, as commodities kept rising, that fund did very, very well. There was a big bearish sentiment. People kept getting squeezed and it kept going higher and higher. And then something turned. And when it turned, it went very, very quickly. And that's what concerns me about some of these archetype investments, that you've seen this very similar sort of pattern, and that's where I see that froth. I mean,
Lisa, it basically comes into hydrocarbons within the high yield space.
Well, there definitely is concern, and something that Peter was talking about, this idea of the concentration in the names. And actually, ARK Investments has about 10% concentration, and I believe 29 companies. Peter, aside from just small bubbles that burst, is there a way to play this, whether it's shorting, whether it's using some sort of instrument or staying away from certain indexes?
I've been staying a little bit away from the NASDAQ 100. It's more concentrated. There's more exposure there. I've liked the Russell. I've liked really sub-indices. I like XBT, XLE, things that are going to benefit from this infrastructure spending, the things that have lagged. I almost start with a chart that anything that's not 5% above where it was January last year deserves a second look. Anything that's, 50% above where it was January last year probably deserves a second look the other direction.
Just real quick, Peter, I know that you have an expertise in credit, and I do want to get your view on what we've seen with respect to the rise in interest rates. And I'm wondering, from your perspective, at what point, with Treasury yields rising, is it a concern for you with creditworthiness, with the idea of how easy it is for some of these companies to borrow?
I'm actually not worried about it. In fact, I think this is going to be very healthy for the credit markets. I think really last year what we saw was companies issue a lot of debt. I think they got ahead of this. They issued as much long-dated debt as they possibly could get away with because of those low yields. So one, they've locked in debt, so you don't have a lot of roll-off. And I think companies in general are going to be comfortable with having debt roll off because they overissued last year. So I think companies actually did a very good job of capturing low yields. So I think we're going to see a dramatic drop off in investment grade and high yield new issuance, especially in the investment grade. And that's going to be very supportive for the credit markets. If we get a sense that companies do need to borrow, I'd get a bit concerned. But I think they actually did a very, very good job last year in terms of managing their balance sheet.
We've had some monster supply, some monster issuance over the last 12 months. Pete, good to see you, sir. As always, Peter Cheer there, Academy Securities Head of Macro Strategy. Tom Keene, things improving on the morning just a little bit. We're down 0.2 now, off by 7 points on the S&P.
The tape's definitely got a bid to it. You watch it, you see it confirmed in the yield space. You've got the 30-year bond out 2.23%. John, Megan Fitzgerald just channeled John Farrow. She's a professor over at Columbia Health. And she shows a chart of Europe, which is basically the United Kingdom, Turkey, maybe Germany, getting the vaccination story done, and everybody else just a colossal failure. I think so many of our viewers and listeners don't understand the massive failure in Europe and what that means for the financial system.
They started later and the gap's not closing. I think that's the problem. So you take France right now, 2.4% fully vaccinated, 4.6% of the population, one shot. The UK, you compare that to the UK, who have focused on one shot, one dose. 30.4% of the population has had at least one shot in the UK right now. And the United States numbers are great too. 15.3% one shot, almost 8% fully vaccinated. The compare and contrast, Tom, is pretty clear.
And you see it again within this idea. I mean, let's go back to Bill Gross years ago, John. It was about a locomotive, whoever the locomotive was, and the assumption the cars were behind it. Are there any cars behind the locomotive?
I remember coming out of the crisis last time around, Tom, and the one thing we talked about continuously was decoupling. With the US decoupled from what was happening in Europe. And Europe is not looking good coming out of another crisis once again. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Futures are negative. We're down 7 on the S&P. We're off 0.2%. This is Bloomberg.